Good morning, everybody. Thanks for being on the call this morning. I know it's kind of a holiday week, so I appreciate you put in an effort. Last week's 5Q tape breakdown was about the FIA comparison table. And the advisor does some things well, but makes some mistakes with the spouse. And this is a great lesson for you guys to pay attention to, because you got to get both spouses involved. So if you haven't didn't listen to that last week, go back and look at that. This is just a warning. The world's best performing stock in 2019 just lost 98% of its value in a single morning. So what does that tell us about, and I can go through example upon example upon example about following the next best thing. I mean, what does that tell us about following the next best thing? I have to get my box open. I don't have it open. Here we go. It's not the best thing to do. I would actually keep this article or find this article, guys, for your clients, that just have it in a folder for your clients that find that next best thing, you know, because they talked about it at the investment club they want to sink a lot of money into. The big endowments, and those of you that pay attention a lot to money management probably saw about 10 years ago there was this big thing about how Harvard and Yale and some of the endowments manage their funds, and there was formulas that they used, and they were recommending that we just follow what they do. But this gives you a great indication, and this was sent to me by Mike, about why that may not necessarily be the case. So a lot of investors feel Harvard and Yale endowments pain right now. Think you had hard times beating the U.S. stock market? Consider Harvard University's endowment fund, which is at $40 billion, is the largest academic endowment in the world. It is run by some of the smartest investment managers around. So, I mean, are they Yale and Harvard? Are they hiring the doughheads to manage their funds? And like Mayo Clinic too, are they managing hiring the doughheads or only the best? Exactly, Nick, only the best. So yet in the fourth fiscal year in a row, and 9 out of the last 10, Harvard's endowment lagged S&P 500. Here are the specifics. For fiscal year ending June 30, Harvard reported last week that its endowment gained 6.5% versus 8.2% for the S&P 500 on a dividend-adjusted basis. The only year that it beat it was in 2015, and it beat it by just a half a percentage point. By the way, Harvard's mediocre performance is an outlier. Other large university endowments also trailed the S&P 500 for the year ending June 30th. Yale University, for example, reported 5.7% increase, Dartmouth 7.5%, and Stanford 6.5%. Now, here's what I want you to think about. What advantages do these endowments have over your money manager? No taxes, yeah. What other advantage? Don't need to take risk. Lower fees, Till, that's the big one, and there's another one too. What do your money managers have to be able to deal with on a daily basis that Harvard doesn't need to deal with on a daily basis? Well, you're right, Tom. That's right. Trading liquidations. Trading liquidations. So who should be able to outperform, the endowments or your money manager? Because when you got trading liquidations, they have to keep liquid enough that they have to be able to pull money out for the people who want money out. They have to deal with the general public who makes good ideas or bad ideas. If you were going to run a fund, would you rather have to be at the whim of all your investors, or would you rather just have the money with no investors, dealing with that, no investors and what they want at all? So if anybody was going to win on this, who would win, Harvard or your money manager? These endowments or your money manager? So that tells you how hard it is to beat these things. So people always think it's so easy, you know, a good idea that it's so easy. Just like flipping a house. On the surface, it seems like what? When you see it on HGTV, flipping a house seems what? Easy. Every time they flip a house, guess what? How much money do they make every time they flip a house? Tons. So I'm confused. Why are we not all flipping houses? Because it doesn't, you know, remember that old commercial with the two older ladies, and the lady was getting confused, I forget about what, and then the other one said, it doesn't work that way. None of that works that way, because everything seems so easy, but it was easy. Guess what? Everybody would do it. Here's another great example. This guy's been in the news a lot lately. So if we go back to President Trump's net worth, Forbes back in '82, or right now, 3 years ago, Forbes said he was worth $4.1 billion, and President Trump said he was worth $10 billion. So let's give President Trump the benefit of the doubt and say he was worth $10 billion. Well, in 1982, Forbes said he was worth $200 million. President Trump said he was worth $500 million. So again, let's give him the benefit of the doubt. So let's say he was worth $500 billion. So let's do the math here. If all he had done is sold his real estate holdings in 1982 and invested the $500 million in the S&P 500, from 1982 to 2019, S&P 500 annualized return was 11.83%. That means $500 million at 11.83 for 37 years would have been worth $31 billion versus his $10 billion. So what does that tell us about investing? What does it tell us about how hard it is to beat the index? Harvard can't do it. A real estate mogul like Trump can't do it. Real estate net alternatives are not all that. I always crunch the numbers. The only better investment is one that doesn't lose money. If you looked at, I don't know if you remember, about 6 months ago, I did a call where I went through all the giants for the last 100 years, all the investment giants, quotes from the investment giants over the last 100 years. And does anybody remember what the one thing they all had in common, what their quotes all had in common? I think there was like 30 investment giants, and I went through all of them, and they all had quotes. And what was the quote that they all had, or what characteristic did all the quotes have in common? They all, like Bernard Baruch, Warren Buffett, Benjamin Graham, they all said not losing money is the key to invest. That's right, Lonnie. Don't lose money. They all had capital preservation as the number one rule to becoming wealthy. So remember, not being in the top stock that can lose 98% in one day, like we started the call with, but in things that can't lose money. And when you look at how the FIAs have done over the last 20 years, they've beaten the market. Why? Because they perform unbelievably. I mean, we don't sell FIAs as a way to beat the market, but they beat the market anyways. I scratch my head when guys want to be in assets under management because in the last 20 years, FIAs have beaten the market anyways. We don't sell them as that. We just go to the guaranteed money. But why did the FIA beat the money, or beat the market? Because they perform unbelievably well? No, they perform lousy. They perform lousy. Yeah, they don't lose money. That's why. So I want to talk a little bit about retirement income planning and how, first of all, how important is that to our clients, the people we deal with, retirement income? Very important or not important? Of course it's very important. So we use the sale or the bucket strategy. But there are lots of different ways we can do this. And we should be up to speed on this. Now, we ask them these questions about how would you like to have a way to increase your income? Well, first of all, how would you like to be able to look at the 9 or 10 or what do we got? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 different ways you can withdraw from your savings without changing any of your investments that would give you more income, less chance of running out of money, and allow you to pay the least amount of taxes. Or there's a way to increase your income by 25 to 100% with less chance of running out of money. So how many of you have actually dived into this and understand what we're talking about down here? Because it's important. Why is it important? First of all, if I pulled 10 advisors aside and asked them, can you tell me what constant dollar inflation adjusted is, constant dollar, or can you even name 5 different ways to pull money out? How many of them would be able to do that? None. Yeah, we're talking about 11 different ways. They couldn't give me 5. So why would that be something that you guys should be good at? It's just one more way. It's just like the fact that our Social Security script. How many advisors know about that about powers of attorney and Social Security? Our competitors, how many know about that? None. So this is another way to make you look different, make you look smarter by you telling people how smart you are, or by you showing them how smart you are. Because people today, baby boomers, they all grew up in Missouri. They grew up in the show me state. You can't tell them how smart you are. You just show them how smart you are. So these are things that you should understand. So these all come from the American Institute of Economic Research, and you have access to that. But they have 8 drawdown strategies, but there's many more than that. So which all fall into 3 basic categories. 1 is a constant dollar category, 2 is a constant percentage category, and 3 is an increasing percentage category. And there are a few more strategies, but the variables are immense and thus difficult to evaluate. So constant dollar means select an annual drawdown amount and adjust annually for inflation. So the 4% rule is an example of this type of drawdown strategy, constant dollar drawdown strategy. This can cause problems due to the sequence of risk returns. Did the 4% withdrawal strategy have problems if that's what you started with in 2000? Yes. And gives a predictable income flow through retirement. That's an advantage of it. Now, the constant percentage withdraws a fixed percentage of the portfolio annually. This strategy is less likely to exhaust assets because the actual dollar amount will go down when the market falls. It also can create an income that varies to a great extent. How many of your clients want an income that varies to a great extent during retirement? From high to going backwards? Yeah, none. Increasing percentage draws an initial percentage of the portfolio and adjusts that percentage upwards through retirement. Theory is that for every year you age, that is one less year you need for money for. Thus, an increase in percentage withdrawn. But does that make sense, guys? How many of you? Oops, let me go back here. How many of your clients want more and more money as they get older and older and older? I mean, I want. When do we all want to be rich? We all want to be rich when we're 20, not when we're 90. So they want that money now. So the 8 strategies: constant dollar inflation adjusted, constant percentage, smooth percentage, constant percentage ceiling, constant percentage ceiling floor or percentage floor, inflation adjusted percentage, increasing percentage, and RMD percentage. And then we have others we're going to touch on here in a little bit. Constant dollar inflation percentage starts with constant dollar and adjusts annually for inflation, not adaptable to market returns, but it does have predictable income. It's susceptible to sequence of return risk. 4% rule is again an example of this strategy. The constant percentage withdraws a constant percentage at the beginning of every year. It allows for more adaptability for market changes. Income can be very variable. Smooth percentage, similar to the constant percentage strategy, the one we just talked about, except it uses average of the previous 3 years of drawdown to smooth out that consumption. So you don't have, if the market goes down a lot, you're going to use the last 3 years, so it means you'll have to reduce your spending a lot less than you would if you just went by year. Constant percentage ceiling, similar to the constant percentage strategy, the 4% type strategy, except it caps the drawdown in any given year to the original drawdown amount, adjusted for inflation. So it's more conservative because it can lower dollar amount in bad years, but strong investment returns will not be met with increased drawdown. So that means you're going to, when market goes down, you're not going to take out as much, but you're also not going to increase as much on up years. Constant percentage floor is a strategy that floor is instituted versus a ceiling. Obviously has a higher upside and an increased risk of exhausting savings. This is the complete opposite of the one we just talked about. Inflation adjusted percentage. This strategy starts with a percentage to draw down and adjust that percentage with inflation. The percentage goes up when the inflation goes up and down when inflation goes down. This strategy is adaptable to market conditions, but is again susceptible to savings exhaustion. Increasing percentage. This strategy starts at a drawdown a certain percentage of the portfolio and increases the percentage by 5% each year. Percentage drawdown is capped at 10%. Operates under the theory that each year gets us closer to death. Again, how many of your clients or us ourselves want more and more money as we get older and older? I mean, we want it to be adjusted for inflation, but do we want more money as adjusted for inflation, or really as we get older, we're not traveling as much, we're not doing as much, etc. Yeah, we want it now, exactly. So required minimum distribution, duh, we all know about that one. Prior to age 70, use the inflation-adjusted constant dollar strategy and then RMD. But we talked here about 5-6 months ago about the HECM, reverse mortgage type. And what does that give people? What it gives about 95% of the people we work with, what's that going to allow them to do? More income with what? How much more income, first of all? I mean, this is crazy. Using the HECM or the rule of 30, or if you're more conservative, the rule of 38, you can increase their income by 25% to 100% at the same time reducing their chance of running out of money. Because guys, this is miraculous. Think about this. When you increase somebody's income by 25 to 100%, the chance of them running out of money should go up or should go down. If you're increasing the amount of money, it should go up. But in this case, it actually goes down. Now, the big thing to understand here is they showed what most financial advisors do for this is they say, we're going to just use your investments, and then if we run out of investments, we can go to your home equity. And what they find out, what did the study, the three different research studies on the HECM, what did they find out? That if you instead use the HECM or the home equity as a backstop, as a last resort, what they find out? Good thing to do or bad thing to do? Bad. They all ran out of money. Exactly right. So these are good things to know. So what's the best choice? Well, as Mark Twain said, there's three kinds of lies. Lies, damn lies, and statistics. And see, all of these different ways, they're all contenders because on paper, they all look pretty darn good. But in 1928 to 2013, 553 historical rolling return periods. So this is what the study looked at, this American Economic Institute looked at. They assigned each of the withdrawal strategies a utility score. The utility score is a score that reflects both the average annual spending and the minimum annual spending. So a higher utility score occurs when you have a higher and stable annual spending is supported. So do you want a high or a low utility score, guys? You want a high utility score. So lower utility score occurs when retirement spending is too low and account exhausts. Now they use Monte Carlo strategy, but there's problems with Monte Carlo strategy. So if you use historical versus Monte Carlo, historical is more realistic because it accounts for momentum both up and down. Monte Carlo results in higher utility scores because random and uncorrelated returns fare better with most strategies. So which one do you think we want to use? Historical or Monte Carlo? Yeah, historical. So here are the results. Now these are actually other, actually this is not the results. I'm going to show you the results in a little bit. But this is other, we just covered 8 different ways to have withdrawal. There are other ones as well, like endowment formulated strategy, endowment strategy with 3-year moving average, Bengen's dollar floor average, Vanguard's percentage floor, Kitz's ratcheting rule, Guyton and Klinger's decision rules, Zolt's glide path spending, and then a modified RMD. So there are tons of different ways to pull money out. But what is the advantage of telling a client that, listen, with your current investments, have you done an analysis without changing a single dollar of your investments? Have you done an analysis to find out which is the best way to pull your money out? Have any of your clients done that, do you think? Do you think any other advisors are doing that? Yeah, no one has. So you got to utilize, ratchet. Anytime you can have something that nobody else is doing, none of your competitors are doing, you need to ratchet that. You need to really lean on that as a elevator speech, as a unique selling proposition, and certainly when you're working with clients, you need to talk about that because look at how different these things are. So we're talking about this. They started out with a $100,000 portfolio. This was the initial spending rate, and this was the amount remaining. And this is the real spending, as compared to inflation. So if you think about a constant inflation adjusting method, you start out with 4,180 on the 100,000. 4.18% is 4,180, and at the end you still have 4,180 in real dollars. Does that make sense? Because you were adjusting it for inflation. So whatever you were able to buy with 4,180 and when you first started, you could buy the same thing 30 years down the road. Does that make sense? Can I get some whys if that makes sense? Okay, so what we're looking for is a methodology that would end up with a lot what? Higher. And look at these. So you have, look at how how variable these are from 4,000 to 7,000, 5,800, 6,900, 9,860, 9,370, 5,670. So guys, is it important to understand withdrawal methods? Are these the same? Are these radically different? Are these radically different? They're way different. So let's look at some of these. So you start out with 100,000 with the inflation method. You adjusted your spending for inflation every single year. You would have ended up with in the 90th percentile. 310,000 in the 10th percentile. You could have gotten down. Your 100,000 could have fallen to the lost basically 90 or 85% of its value. So best case scenario, 310 it grew to. Worst case scenario, you were nearly running out of money. Okay, so let's go down to some of these higher ones here. So if you go to the Kitchens-Ratzinger rule, again, you were spending a lot more money. 10 years, 5,000 versus 48, 86, 60, 93, 70. But again, do you want to be able to spend more money as when you're 89 years old? Is that really helping you? No. But you do look at how they look at it. You spent a lot more money using that method. You spent a lot more money. We're able to spend a lot more money. And best case scenario 222, worst case scenario 14170, which is basically the same as you ended up with here. You look at Guyton and Klinger's decision. You start out with 6.34, so you started out with what? 69.70. You're spending a lot more, but look at what happened to how much was left. Not much, right? So it really, the way that there is no clear winner with any of these. It depends what people want. Do they want to be able to spend more throughout their lifetime? Do they want to be able to spend money and then the beginning amount was 100,000? So somebody asked what the beginning amount was until the beginning amount was 100,000. So but the thing is, you have to figure out what people want. Do they want the most income early on in their retirement? Do they want it to be able to buy more and more and more? They're driving a Chevy now, and they want to be able to buy a Cadillac and then a Bentley when they're 89 years old. Do they care about how much money is left over? There's all sorts of things to be thinking about. But if we go back to the utility scores for the 8 strategies that we utilize, you can see they're still radically different. So you have inflation-adjusted percentage, constant dollar, and constant percentage. Those are the 3 basic types of, there's versions of this, versions of that, and versions of this. But remember, we started out with this conversation with these are the 3 basic types. And look at the utility score. 4.17, worst case, 6.13, 2.65, 7. So this one, at 3%, you can see it's a little bit higher. 3.5, but this is higher. So look at that. Higher or lower percentage here? Higher, and the utility is higher. So it's constant dollar compared to inflation adjusted, the utility score is higher. Constant percentage, it's not very good either way, right? So does it make sense to have some working knowledge of how people pull money out? The best average utility score, constant percentage floor. Problem is it got killed. So even when you pick the right thing, you get killed in the poor outcome and exhausted savings many times. So in conclusion, retirees face 4 major retirement financial risks: uncertainty of lifespans, fluctuating market returns, inflation potential, and unforeseen personal expenditures. And guys, do any of us have a crystal ball and know what's going to happen in the future? No. So here's the main thing we need to draw from this. The first 5 to 10 years of retirement are critical to long-term outcomes. When the first 10 years go well, guess what? If your first 10 years of retirement go well, guess what you can do with your income? It's awesome. Whatever you want, because everything's going to be perfect if the first 10 years go well. If it doesn't go well, you better be able to understand what happened. So here's the one general rule is to spend as little as comfortable at the beginning of retirement. Again, is that what most people want to do? When they first retire, when do you want to go on all your dream vacation trips? When you're 85 years old, or the year that you retire? The year retired. That's when you want to do it. I mean, really, that's a good way to approach it. But I'm becoming more and more, I'm moving more and more to the Kitces and Wade Foe's mentality of this glide path, where what you want to do is start out with they've got a 30% or 35% in equities when you first retire. And then as time goes on, you can slowly increase that percentage in equities up and up and up until you get to the 60% level. Here's the funny thing, though. If things go well, if you start out with 35% and you leave that and don't rebalance every year, essentially what would happen anyways? If you had that guarantee at 35%, so eventually this is going to go up anyways if you don't rebalance. So it's going to actually work perfectly. And why do they have it so low here? What are they avoiding? What's the one thing that can kill retirement? Why do you start out so low here? The thing is, we don't have a crystal ball. Do we know what's going to happen in the next 10 years? Yeah, sequence of returns, guys. That's right, sequence of returns. So we don't know what's going to happen in 10 years. We don't know if it's going to be a good 10 years, bad 10 years. But if I was to guess, since we're now at the end of year 11 of the longest bull market possible, am I going to guess that the next 10 years we're going to have another 10 years of the longest bull market in history? Or am I going to guess that the next 10 years probably are not going to be as good as, I don't know how bad they'll be, but am I going to guess that they're going to be as good as the last 10 years? Have we ever had a 20-year run like that? I mean, 65 to 87 was crap. 65 to 87 was crap. You basically lost money in the market. But then from 87 to 2000, 12 years, it went great. But then what happened from 2000 to 2018? Not 2000 to 2018. 2000 to, well, basically 2000 to 2018. It took you how long to get back down to even again? 13, 14 years. So if I was to guess, the next 10 years are going to be great. So if I had clients who were in their 60s and early 70s, where am I going to have them? High in a lot of equities or in less equities? Yeah, low risk. So returns are rarely average. And let me give you an example of that. For 100 years, interest rates never went above 5%. So look at this. So for 100 years from the Civil War, well, they went up for 5% for about three months here. But from the Civil War on, for 3 months they went above 5%, but then for almost 100 years, they never went above 5%. So guess what all financial advisors for those 100 years were telling their clients about interest rates? What were they all telling their clients? Interest rates could never what? Yeah, they could never go higher than 5%. Now look at this, 4% here. For 1790 to basically, so almost for 80 or 90 years, they never went below 4%. So guess what those advisors back then did? And I was guilty of this because when I became an advisor, it was in the 80s. So look at this. I told my clients that you know the guarantee was 3% on annuities, right? So it was 1957 since we'd seen 3% interest rates. So guess what I told my clients about us ever seeing 3% interest rates? Man, I mean, since 1957, I mean, it's got a 3% guarantee. And when you told, remember this? When you told clients that had a 3% guarantee, what did they say? The hell, 3%? Are you kidding me? That's all? That's crappy. And I said, yeah, but you'll never see that. Now, how many people would be happy with a guaranteed 3% guarantee? So the point here is what? Do we have, just because things have gone well for the last 100 years, does that have any bearing on what's going to happen in the future? Certainly, just because things have gone well in the last 10 years or 11 years, does that have any bearing on what's going to happen? No. None of us have that crystal ball. We don't know what's going to happen. It could be a sunstorm that blows out all of our satellites. It could be a China problem. It could be some dumb guy in the basement figuring out another way to create a flash crash. We don't have any clue. What is the number of things that could go wrong in the future? Yes, infinite. We have no clue. Of all these 7 major stock market crashes over the last 40 years, are any one of the causes identical? Was there ever no, none of them were, exactly. So the conclusion is, the study finds that 3 to 5% initial drawdown has been historically ideal. Outcomes are also maximized when flexible strategies are employed. So how do the 21-point checklist strategy leverages? So first of all, do we do financial planning? Do we present, and again, guys, some of you that know me, I was the #1 financial planning salesperson for IDS, or Ameriprise as they call it now, in the state of Minnesota. I could sell those things like a son of a gun. Couldn't sell any of their investments, but I could sell but what was the problem with them? What's the problem with financial planning and income planning software? If you're going to guess what inflation rates are, if you're going to guess what the rates of return are, if you're going to guess what the withdrawal rates are, the day that you hand it to them, what happens? Yeah, the day it's printed, it's still exactly right. It's outdated. So we don't do that. Instead, we don't predict. We evaluate every single year, and we put our clients in the best thing possible for that year. The next year we look at it, and we put in the best thing possible for that year. We do not predict. Because when you predict, when you hand that to them, you may say, now this is just a hypothetical, but what do they see it as? What does the client see it as when you hand them that? It's concrete. It's real. They look at it as you guaranteeing that's what's going to happen. Don't give them that. So we use a 50-50 mentality because why? Why do we use a 50-50 mentality? Because we don't know what's going to happen in the future. We plan for both the good and the bad. We protect them against the unforeseen. We educate ourselves and our clients. That's why we're different from all of our other competitors. So I can't we're in the season of Thanksgiving. So I'll just tell you, I thank all of you guys for making your practices better, increasing your knowledge, being a better financial advisor to your clients. I can't tell you how much I appreciate that, and I appreciate being associated with you, your willingness to work with us here at 5Q, especially with me. And I appreciate all you guys. You guys have a wonderful, wonderful, wonderful Thanksgiving. And don't worry about doing any of these things for the next week. Take some time off. Have a good time. And then I'll use December to really get ready for our 2020 year. So happy Thanksgiving to everybody on the call. Hope you have a wonderful holiday week and be safe. Don't eat too much, and we'll talk to you all next Monday. Thanks, everybody.